so much. Sean
Yeah,
is here.
if I can just
Go
do a
ahead,
little
please.
introduction, Dave,
You
I'll just
bet.
do a little introduction for you. So anyway, this session is called What to Expect at or Near the Close. This is a very important session because a lot of work has gone into the M&A process up to this point. Lots of money has been spent, lots of emotions are flowing, and we don't want the deal to crater at the very end. So this is a very important session for us to listen to. We have two gentlemen that are speaking on this session. David Sider, who is a partner of the law firm of Spencer Fane. He has a great wealth of experience in doing lots of transactions. You'll see that surface in a minute. And also like to introduce Sean Ostrander, who is a vice president at Merit Investment Bank. Sean has been advising and executing on M&A transactions for 10 years with a total enterprise value of roughly $1 billion. So we're very nice here. So I'll turn it over to you.
Well, I am an attorney, so the fact that you say I'm a gentleman causes me to ponder for a moment, but thanks for the introduction. Can everyone see the slide presentation? Is it up? All right. So here's the good news. I've been listening for the last couple of hours. Literally everything that's been discussed now comes home to roost at this point when we're getting close to the end of the transaction. So all of the things, the government issues, the antitrust issues, financial issues, you name it, they're all on board now as being significant to what's transpired. This is the part of the M&A that we commonly refer to as deal fatigue. At this point, you're out of gas. You've been beleaguered with due diligence requests. There's a lot of information you've had to come forward with, and you're at the end of the transaction. So you're going back over this checklist. And at this point, remember, most all the documents are signed. So there's really not a whole lot out there that you have to think about other than, is everything that I say in the agreement true and correct? And is there everything in place so that I can close as far as, number one, the financial performance? Have things changed? Number two, lending. A lot of times there is a lender in the background that has to be released, or we need to get the final papers approving financing of the transaction. Number three, consents. Consents throughout the company, number one, the shareholder and the boards, but there may be third-party consents on contracts. There may be creditor liens in place that we have to get released. There may be government regulators. You heard an excellent dissertation a minute ago on antitrust, both domestic and foreign. And I will tell you too, they're also beyond just the notion of antitrust. There are also regulatory issues that deal with just doing business in another country. That was discussed earlier today. The big thing that I see is at this point, the contracts with third parties are very significant because maybe we didn't get everybody's approval, and these are significant customers or vendors that we're going to get on board. I finished one deal, a very large deal late last year, and that was a huge issue for us to make sure that we had all that reconciled. It slowed down the process. Obviously, landlords, we got to deal with the issues on any leases that are out there, major customers and contracts. How are we going to deal with them? And what does that look like? And then finally, insurance. You're going to be changing over from one company to the next, whether you're on the sell side or the buy side. How are we going to deal with that? Sean, any thoughts that you want to bring to the table? I'm looking at it from an attorney, a very, very narrow view. Sean, let's look at it from the investment banking side.
Yeah, I think the hardest part that people don't really anticipate, I think when you have a letter of intent signed and there's kind of a, we're going to close in 60 days or we're going to close in 90 days, a lot of things have to go right to hit that timeline. And I think the piece that most sellers forget and don't fully recognize, essentially you have 15, 20 cooks in the kitchen on a really small deal. You have multiple attorneys on either side, depending on the investment banking team. You might have 4 or 5 people on that team. You have the seller group. You have the insurance teams. You have the lending team. You have a lot of different people that all need to understand things simultaneously, and they all have their superiors and stakeholders that they have to respond to and answer to. So all of these things, Dave, that you just mentioned are all part of that, right? And the hard part is that the seller is usually looking to somebody to kind of drive all of this process. So, when I get asked, I get asked, and, some people raise eyebrows when, I say, yeah, we're really involved throughout the closing process. Because a lot of, brokers or other investment banks will kind of get to LOI and then trust the management team's going to close the deal. The problem there is that you have essentially kind of conflicting, you have conflicting goals there, right? You have one side that wants to, minimize retrade. You have another side that wants to, ensure that they get a deal that is as good a structure as possible. Essentially, our role is kind of marshaling every single one of these aspects to ground and keeping people moving. So, I mean, landlord consents, right? I've been on a deal where we were held hostage by a landlord for 10 grand. And essentially just, split it with the buyer, right? Because they wouldn't basically sign over a consent. And one of the conditions to close was a landlord consent. Lien releases, you mentioned creditor liens here. If you have a lender that is a larger bank that has a large, big law attorney team, they will want specific release language, and sometimes the bank's lender is not ready to get into a back and forth with a Kirkland & Ellis or a Wachtell. So a lot of times the kind of communicating about timelines ahead of time is really important to ensure that all these things move ahead. But end of the day, if the seller hires a good law firm that knows what they're doing on the M&A side, really shouldn't have much issue.
So none of this apparently, Sean, is self-executing. It just doesn't automatically happen. There's a lot of work that has to be brought on board. And so at this point, as an attorney, I'm sitting there trying to literally go back to everybody that was on the podcast the last 2 days and confirming that they're ready to close. They're ready to close. There's no open issue. Oh, there's an open issue. How are we going to deal with it? What's your recommendation? And you put it all together in a ball. And remember, this is probably within somewhere around 15 to 30 days of closing. This is not something that's going to be early on. For some reason, it all gets discovered at the very end.
Yeah.
And so we wind up finding all of these issues here that we have to deal with. We put ourselves into what we call a risk of retrading, which, ladies and gentlemen, we never want to be there. But here's the reality. These are ongoing businesses. Things happen. Lines of credit get stopped. People stop paying their debts for whatever reason. You wind up finding yourself in a lawsuit. Oh, here's an IP issue that we didn't discuss before. Or a situation I ran into a couple of years ago. We know there's an issue with a piece of real estate, but we don't know the magnitude of the issue, and there's going to have to be some cleanup work. So they want to come in at the 12th hour and discuss. Here's the deal. A letter of intent depends on the state, but most of the time a letter of intent implies good faith and fair dealing on everyone's part. So our objective on the sell side is to be as upfront and transparent as possible, because we don't want to retrade. When we're in the last 2 weeks prior to closing, when you're out of gas, this is not the time to start doing really intense negotiation. This should be the time when we're cleaning up things and getting put to bed. But it's going to happen because in the lifeline of your business, issues come up. It's not uncommon that probably about 2 weeks in advance, and we'll talk about that in a minute, you're going to be talking to employees about what's going on, and it's going to create a lot of nervousness, and there's going to be a lot of conversations that we go through. There is no way to prevent that. That's going to happen in each instance. But think about putting together a plan of due diligence that you're going to disclose those things that you know are going to be problematic to your attorney, your investment banker, so we can get out in front. We want to know that at the beginning, because at the end, the prices are much higher. First of all, buyers will be able to, through the due diligence, figure out where the deficiencies are. It's not lost to them. They will drill down and drill down and drill down until they get the answers that they want. So when you find the issues, let's discuss them in be in a position we can talk about and come up with solutions and the rationale for it. Most of the time, I have found on the buy side, if you come to me with the opportunity and what's going on, I'm going to be able to figure out some way to resolve it. Nobody's going to win all the marbles in the marble game. There's going to be some sharing going down that road. And you want to make sure that you understand it not only internally, but externally. What does this do to somebody outside the business? And typically it's going to be, in my experience, the lenders come along and there's some new kind of issue that comes up. Several deals I've got, not only see that the buyer is doing due diligence, the investor for the buyer does due diligence, the rep and warranty insurance underwriters doing due diligence, and the lender behind all this is doing due diligence. They don't always do it all the time at the same time. In fact, they never do it at the same time. So you're going to have this sequential approach of issues that come up. Sean, tell me, investment banker, what have you seen in going through this analysis of retrading?
Yeah, so I'd say that most, and the most implies majority, most retrades that I have seen, and I guess definition of retrade, it's important to call out kind of what that is. It's a material kind of change in the structure. So whether that be a purchase price, or hey, I was going to, pay you 50 million and now I want to put 15 of that on an earnout, right? That you're going to earn over 10, the next couple of years. That's a material change, right, to the cash that you have at closing, right? What I'd say is that most of the time that a structure change is proposed by the buyer, most of the time there's legitimate reason for it. Now, I've also seen a couple situations where the buyer knew that they had a seller that was desperate during a fire sale or something like that, where they knew that they had the leverage and they decided to apply that pressure and say, yeah, we knew this information, but realistically, looking at the economy, yeah, we're just scared and we just can't do this deal. The reality is that a letter of intent, while it implies good faith and fair dealing, it's also non-binding. So it's a push to close as fast as you can and make progress every day to minimize the risk of not closing. So I've seen deals fall apart because of, essentially an unfair retrade, right? I've seen deals get closed after an unfair retrade because the seller was desperate and that was the option and all the other diligence was done. I had a transaction last year where a business was based in the Southwest. 30 days before closing, the landlord, they had been negotiating the lease, and where a 30 to 40% rent increase was included in the projection, turned out to actually be about 130% increase in the rent. So essentially, the go-forward EBITDA of the business was lowered by $1 million. And end of the day, that that combined with some other areas that were really more smoke than fire, caused the deal to just fall apart, right? The investment committee of the buyer had to go pencils down because there was too much noise. And a buyer at a traditional private equity firm that might be on a second or third fund that has committed capital versus a family office that has a couple $100 million sitting in the bank, literally, and a independent sponsor that has to raise the capital, or a strategic, right, like General Mills or IBM. All of them have different types of diligence that they have to do, and all of those play a factor in what drives a retrade. I worked on a transaction recently with David Wanatek, who's here on the call, and where I was expecting a retrade multiple times because the buyer had a portfolio company in the space. The little areas, they weren't essentially going to over negotiate in the margins. So they said, the number's close enough on the quality of earnings, on the financials, and the rest of this, we've recapped the business at a higher multiple, so we're just gonna go ahead and and stick to the original deal. And it was a great outcome for our sellers and hit their goals. So it reminded me that a lot of times, not a lot of times, every single time, people are, their goals are typically up front, and it's a function of, does the diligence pencil with that thesis and those goals?
So at the end of the day, here is the lesson learned to take away from this. You know, there's some issues up front. It's time to do, for lack of a better term, kind of a mock drill of when the issue comes up, how are we going to deal with it, and look at the parameters. Do not go in blind and don't go in wanting everything. There are going to be issues that come up. I have rarely seen when it's in anybody's best interest to completely walk away from the deal. I have seen, to the point that Sean raises, that sometimes it stops and then it restarts, but not so much a termination of the agreement. That leads us to the thought process of then, if we're not going to close, why are there sometimes what we call exclusivity extensions? More often than not, and this usually comes up, I would say, Sean, more in the LOI period, not so much during the deal or once a definitive agreement is executed. There is usually some type of challenge. Usually, in my experience, it's more money, A, or B, that is lending or finances, or B, there is some type of, frankly, liability or some type of a huge risk profile that a client can't get around. In this scenario, I always want to know up front, am I dealing with a financial buyer or a strategic buyer? If I got a financial buyer, then if they have no knowledge about this business, or very limited about the industry, then there's an excellent chance that they're going to take a little bit longer if they're going to do a full tilt type of investigation on the business prior to signing the LOI and or prior to signing the definitive agreement. I need to be prepared for it because it's just going to take a little bit longer. How do I get them comfortable? I don't see that very often with strategic buyers because usually outside of financing, usually the issues that exist from the sell side is probably going to be understood by the buyer. They're more readily to accept the risk. And I'd ask you this, Sean. It seemed like prior to 2020, when there was so much money floating around, whether you're a financial or a strategic buyer, they were willing to take a heck of a lot more risks. Now, and ever since COVID, it's really backed up, in my opinion. So a financial buyer may come forward right now and pay all cash. That's something new I've seen this year. I haven't seen it in the prior 3 or 4 years, but they will really put you through the ringer. I think at this point in the economic cycle to look at the risk factors with your business. What do you see from an investment banking standpoint?
Yeah, so I'd say the only correction I would say is it wasn't just pre-2020. I'd say the second half of 2020, second
Yeah.
half of 2020, I think was the highest volume and highest value cluster of
Yes.
deal closings that I saw on our side.
Yep.
So you had a ton of pent up, right? You had pent up demand for good deals. You had PPP loans going around, and you had debt markets that were not sure what was going to happen, and you had tech companies that were growing like crazy out of that trough. So we saw some pretty silly multiples in transactions that were typically done all cash. But I mean, there was buyers didn't know what to do with PPP money. So all that to be said, I think specifically to the exclusivity dynamics, I think in 1819 there were fewer external reasons to not get a transaction closed within the exclusivity period. Post 2020, you had interest rate craziness, you had wars popping up around the world. I had a transaction that literally got killed because they were importing most of their products from, I believe it was Austria, and Ukraine was attacked, and they were concerned that they weren't that war was going to spread throughout Europe, and that they weren't going to be able to, supply most of their inventory going forward. So deal got killed. And so there's been a lot more external variables there. So yeah, I mean, I think in general, the bullet there is net effect. Most of the time, exclusivity does not impact a transaction. But I would say that where I typically represent the seller, it is on us, and it is kind of, incumbent on me as the advisor to remind everyone to play within the letters of the document as the seller. You have NDAs signed, you have a process that you've put forth, and essentially, if you are not strict with the buyer in the process, typically you're not going to have any leverage going forward. So when that exclusivity is open and you have an opportunity that presents itself and you're outside of exclusivity, assuming that you've communicated in advance and in, communication with the LOI and the NDA, because outside of the exclusivity, typically you still have to communicate if you're talking to somebody else, right, to the other buyer. So even if that group is okay that you're outside of exclusivity, you still have to ensure that your ducks are in a row legally. But we had a transaction happen last year where the moment that we were out of exclusivity, we reached out to a strategic buyer that had been sniffing around, and they closed in 60 days.
I think as a lesson learned, I usually look at it as the dog bite rule. And that is the first dog bite, is you don't deem the dog as being hostile or rabid. But the second bite means you got to put him down. I'm sorry, that's probably a horrible analogy. It's one that comes from law.
It's effective.
and I love animals, so I don't mean it to be anything other than the standard that we use with dog bite cases. So I think everybody gets one shot, needless to say. After that, not so much. Which leads us to the other couple of areas here that we're going to go down. And these are the three areas that pop up the most when we talk to issues that could be a complication. Working capital or net working capital adjustment. We're going to talk about purchase price adjustment generally, and then post-closing indemnification. This seems to be a place where I spend a lot of time, whether I like it or not. So when we talk about working capital adjustments, let's start with investment banking. I have my definition. Sean, when you were talking about working capital, and either it's net working capital, target capital, projected capital, share with our audience what that looks like and how you analyze it, and then I'll jump in.
Sure. So what it means to the layman, it's important that I call this out because a lot of people, they've been to college, they understand what the definition of working capital is, right? Current assets minus current liabilities. But in a transaction, it usually is one of the bigger sticking points and points of confusion, but can also be a really minimal impact on the transaction. And that's where it's helpful to clarify. Working capital is essentially the gas that is in the vehicle that is the business when you drive it off the lot. It's cash flow, right? It's, if you were to drive the vehicle off the lot and you had an empty tank, you'd have to go fill up, and that filling up is cash. So a lot of times, what happens, and I'd say more than a lot of times, essentially every time, right, unless there's a specific kind of reason to change the structure from a consideration standpoint, transactions are done on a cash-free, debt-free basis. And especially every single time when you have a financial buyer, that's going to be the nuance. So essentially, if you're the seller, you keep the cash, and subject to your liabilities, your current liabilities that were, if you have payroll due, right, you got to pay those off. But if you have, you have to, the cash is yours and the debt has to be paid off as well. So if you borrowed $10 million on the business and you've created a business that functions, you use that $10 million to get the cash that you're getting. So essentially, we're paying you consideration for the business, for the going concern, but you're going to give us, the buyer, a clean balance sheet. So beyond that, it's okay, we get a clean balance sheet, but most sellers ask, okay, what about my AR? And then I say, okay, well, what about your AP? And that's where working capital comes in. So it's essentially, what happens is you look at working capital and you say, typically through a quality of earnings lens, which the buyer will 9 times out of 10 do, right? They'll hire an accounting firm to do quality of earnings. They will adjust working capital. So if you had, unfunded, vacation liability, right? If you had AR that was significantly overstated, if you had deferred revenue that should have been on the balance sheet but wasn't recognized, all of that gets adjusted out in a quality of earnings, or
It's
all of that gets adjusted to the balance sheet.
right. And to your point, at the end of the day, the way I look at it is, first of all, I am going to the CFO and then the
Yep.
outside, either valuation person or CPA, to calculate. What I want to know, and I think the lesson for our folks is, with buyers and sellers, let's agree upon the categories. I've seen net working
Yeah.
capital. You could break it down into
Yeah.
about 25 subcategories.
Yeah. Yeah.
You know, and I've also seen buyers try to back in all their fees. That's always
Yeah.
an interesting phenomenon, which if you're a seller to be on the lookout. Don't get too hung up front on what that number is, because to what Sean said, I got to know how much money to keep in the business. Just let this bad boy
Yep.
run for 30, 45 days. But let's make sure we understand the categories
Yep.
in very, very great detail, especially if somebody's in the quality of earnings. You know, they're not going to share everything with you, but let's get the categories right so we're comparing apples to apples.
Yeah, and in some of those categories, I think it's important to kind of clarify what can drive those difference of categories.
Yes.
A business that is in manufacturing that grows 5% a year, you might look at the monthly working capital of the last 12 months and say, what was the average? And we're going to say that's the peg, right? Or that's the
Yep.
normalized number that we're going to identify that is the gas that's needed in the tank to run the business for the next, to your point, 30, 45, 60 days.
And to your point, this really shouldn't be a point of argument, but it will be something that you're going to negotiate very closely at within 30 days to
Yep.
literally the point of closing. But up front, let's get the categories set up so that
Yep.
there's no misunderstanding.
So yeah, so those categories. So to your point, the categories oscillate depending on primarily, what is included in cash, what is included in indebtedness,
Right.
what is included in AR. Are you factoring in bad debt accrual? All of those things should be clearly called out in the purchase agreement, if not the letter of intent. I typically like to have it called out in the letter of intent if I can get it.
Yes.
So that we can clarify, because I want to know if you were running a retail business, right, or a technology business, and you get, for a retail business, if you've sold $1 million worth of gift cards, and that's not on your balance sheet, I want to know if that's going to be included as part of the average calculation to which I'm going to be adjusted against, or if you are going to have me pay it off all dollar for dollar as part of closing. That can mean a material difference to the seller at closing.
And with everything else going on closing, sorry, Sean, with everything else going on closing, this should be something that should be easily resolvable, because we got a lot of other things we got to talk about. And one of the things is, let's talk about purchase price adjustment. Let me back up for a minute. So net working capital adjusted to net working capital, or they'll say target working capital to actual working capital. You're probably going to figure this out in a 30 to 45 day time frame. You don't really need much more than that. Sometimes they'll take more on very, very large transactions, but it shouldn't be that significant one way or the other, unless there's something that's come up that's just totally outside the realm of what anybody had ever seen or considered in the transaction. I have not seen that very often. This should be a pretty simple analysis. However, let's talk about net working capital in regard to purchase price adjustment, because these are two different things, and sometimes it gets confused. So it is pretty reasonable to say, because of situations, and again, the life of the business moving forward, that there may be a purchase price adjustment for any number of reasons. One of them may be the expectation of what you thought, especially if we've got some kind of variable tied to production, there may be some change in the revenue forecast that says, hey, I'm not going to pay you as much. Let's distinguish, Sean, from investment banking standpoint. Let's talk about net working capital versus purchase price adjustment. How do they interrelate and how do they not interrelate? More so the latter.
Yeah, so typically from a negotiation perspective, purchase price adjustment is the one that will hit directly, will hit harder to most sellers because they see a top line number and they can very quickly in their minds, like apples to apples, compare that to what it was and what it is now. Where working capital can be a backdoor retrade risk is, you know, to David's point, most of the time, and most buyers want to have it be a situation where no one wins per se on working capital. The issue though is that if, you know, in a tech business that's growing 20, 30% a year, and I'm now, you know, 2 weeks before closing, as part of what I'm proposing as working capital, I'm going to ask you to pay off all the deferred revenue that might be $5-6 million, including, you know, instead of having me include a working capital. And also I'm going to require that it be a 3-month average instead of a 6 to 12-month average. As earnings are hitting the balance sheet, the average of working capital is going up. So basically I'm asking you to leave in that much more functional cash in the balance sheet, rather than saying, hey, I think the average is going to be a 12-month, which might be a different number to the tune of $1 million or $2 million, right? Now, functionally, and this practically, it's important to call out, the way this affects the seller is at closing, the balance sheet is estimated, and you compare that working capital number to the average that was agreed upon. And if that number is higher, the seller gets more money and the purchase price is increased. If that number is lower, then the purchase price is lowered, you know, by that amount. So it can directly affect the seller in their wallet.
And to your point, a lot of times in this, on a purchase price adjustment, we might put around what we call a collar. All right. We don't want to sit there and nickel and dime people. So we might say anywhere of an adjustment between 1% and 5%, depending on the size. Larger the deal, probably closer to 1%. We're not going to ask for any adjustments, but there's going to be a delta in there where the deal changes. So you oftentimes, you're not going to probably have this up front. As we go through the financial analysis and get near the end, we're probably going to get into a scenario where we say, hey, can we agree that within these parameters, I'm going to just say 1%, neither side is right or wrong. We're going to call it good and move on down the road, because then we're going to have to bring in, as somebody said, or as you said, Kirkland Ellis or Weil Gotshal, and then we'll be spending more money than the differential is all about. So that's the significant point. I always look at net working capital. I'm sorry, it doesn't relate to purchase price adjustment ever to me. You're going to have to go bend over backwards to tell me how that works. They're two separate concepts. I've seen people get confused by that.
Well, a lot of legal agreements, and I know we got a lot of still, but a lot of legal agreements or purchase agreements will have the working capital adjustment to be directly applied to the purchase price.
Yes.
And that's where sellers can be confused. Versus
That's
it just be a working capital adjustment, right? It's versus separate. So I agree. I like it being separated, but it depends on the attorney that wrote the agreement.
Well, you got to talk to the attorney and go separate it out. Again, depending on which side of the transaction you're on, needless to say.
But I love colors, and to the extent that you can have a deductible, right? Essentially, where we're agreeing that, you know, within 100 grand or 300 grand, whatever the number makes sense, within that kind of margin of error, if we're close, then it's not going to be an issue. If it's bigger than that, then we're going to have an issue. Frankly, if you can get that at the LOI level, it sets the precedent for closing, which tells you a lot more of a seller, as a seller, how the buyer is going to treat you throughout closing, and it's important to know.
So I talked early on about the fact that there's deal fatigue. This will be one of the issues that will come up. It shouldn't be overwhelming. We want to plan for it and deal with it and set up parameters up front. This gets us to post-closing indemnification payments. So inevitably, there's going to be a lot of conversations around the indemnification. The concept is this: if you're a seller, you're responsible for whatever happens before the closing. It's got to be your problem unless it's otherwise specifically dealt with in the agreement itself. That's just the nature of the beast, unless it is a stock purchase. I'm assuming this is an asset purchase in most instances. So in those situations where a demand is made upon you, and rarely, I'm just making this as a general rule, rarely is it the other way around where the seller is going to the buyer because the buyer didn't do something, unless there is an extended payment plan and the buyer defaults, goes bankrupt or whatever.
Promissory note or something like
Yeah,
that. Yep.
exactly. And in this instance, it's usually a buyer coming to the seller. And always, you get the calls from the seller and it makes them nervous. Most deals, they have a thing called a cap, which is the limit of liability. You usually have a deductible of some sort, which could be a tipping or not a tipping, meaning, let's say, the first 25,000, you're not liable for it. But after that, it could be that it's a straight deductible dollar above that. You're going to be liable for, or it could be what's called as tipping, which means you go back to $1. But you will set out the parameters, so you've got a feel for the exposure that you might have. There are market reports put out by the American Bar Association. Acrium, SRS Acrium puts out one. There is kind of a market knowledge that most M&A attorneys know about what the range and parameter will be. But let's assume, for purposes of the conversation, that you're right in the middle of that exposure, that somebody comes to you with a claim. When I deal with it, I go back and look at the deal terms and look at the timing and the reaction. I have usually a pretty good sense on how to deal with these types of matters. To me, it's usually fairly black and white. It's pretty straight up relative to what the concern is. And invariably, it's something that got overlooked that was not otherwise known. There are those situations where fraud was involved. There are those situations where something has come up in the change of the economy and there is no valid or really good force majeure clause. There are things that will come up that will cause a trigger. The best example I have is where I saw a scenario where we were selling a building as part of the transaction. We had a good feel, but we didn't have 100% knowledge the amount of damage, and so we got into an argument. We were able to resolve it. The other things that come up more often than not is a lawsuit that arises that nobody knew about. What have been your real world scenarios, Sean, that you have seen? Can you give us a flavor of that?
Yeah, so a lot of it is driven, and Dave, you can probably validate this, that where the buyer or the seller kind of is motivated to collect damages is a lot of times driven by the intent.
Right.
So I've worked on transactions where, one specifically comes to mind where the seller was fraudulent around, the status of some key key customer contract negotiations that were driving the projection of the business. The buyer paid against that, and within a couple of years, essentially, nothing had turned out, and they went after him for it.
Right.
And things did not end well for the seller, right? And that's a situation where we do our background checks, we do our KYC, right? We collect diligence and review docs like everyone else. We are passing along the information that we've received to the buyers, right? And they have to diligence it, right? I've also seen where a seller simply forgot, right? He was dealing with memory issues, and there was a sexual harassment claim from one of his partners from 15, 20 years ago that was not disclosed as part of the legal diligence. And now the good thing is that was a situation where the transaction had not closed yet, So it was a retrade risk, and there was restructuring around that because they were concerned that that claim was going to lose them customers, right? And essentially they escrowed it for a year or 2 years or something like that. So they just increased the escrow amount, and we still closed on time. But that was a situation where it wasn't willful. There wasn't intent to defraud,
Right.
or exclude information. So what the other piece I would say would be that there's typically escrows that are put in place, to your point, David. There's escrows for a year, 18 months, 24 months, depends on kind of the nature of the business. The goal is to get what I would call market terms around that. So you want to get something fair in the escrow, right? You want to, if it's a $20 million transaction, you want to get $1 million, right? Or 10% of the purchase price, or something there, right? Not 30. The moment I see, hey, we want a cap that's 2x the purchase price, and we want 30% holdback, indemnity escrow, I say whoa. we got to rework this, right?
Right.
And a lot of times that's a call very quickly to the buyer to say, was this you or was this the attorneys?
Yeah.
So because that's a material deal term that's different from the LOI and the understanding, right? So
Well, and the other variable there too is usually it may be one issue that comes up, right? And so you can have a separate escrow for the issue. You might have a global escrow for all things, but if there's something that's really bothering them, then break out a portion of that amount just for that escrow. It's going to save you a lot of grief on down the road. So we know at the end of the day that one of the key ingredients is negotiating employment and consulting contracts. Okay, we're at the point that you got to get the people on board. And I don't know. I think this is probably post 2020. So I'm going to say 2021 to the current day. It's hard to find people, period. And it's hard to find qualified people. And it impacts everyone's business. It impacts my business in a law firm. So the question is, how do you get people on board, and when do you get them on board? And then what do you do that they will be gainfully employed, but maybe they've never signed an employment agreement? Number one, well, that's its own challenge. And then number two, the restrictive covenants that go along with that, and the protections that people will undertake on the buy side. So when I'm representing a seller, the owners by definition are going to sign restrictive covenant agreements. There's a lot going on with the Department of Labor now, and there are a lot of state statutes that says you're probably not going to be able to enforce a non-compete in any state in the union. And it seems like each month a new state adds to this. Because they just manifestly think it's unfair. Everybody has to have the right to work. That does not apply to an owner or someone who has an equity position in the company. The courts will understand that there is an interest there to protect. But at the same time, there may be key people in the company where you want to tie them up, because without them, you're not going to be able to go forward if something should happen. And invariably, the owner's going to stick around a while. That has never worked in recorded history when he goes from being an employer to an employee. I don't know how many conversations I've had where I've said, you're going to have to get out of there, because if you don't get out of there, they're going to fire you. The people in your business will think you're running the business, and they'll report to you and not to the guy who wrote a check. I mean, one of the clients, his famous line is, when people call him, the owner, and go, you're not running this the right way, his answer always is, did the check clear? And he just goes very silent. It's going to be very important you keep the people on board and you talk to them. I recommend to our people never to talk to the employees in any great detail until the definitive agreement is signed, because until that point, you don't have a deal. And you still want to be careful because of the caveat somebody will back out. So that's usually the time where you're getting everyone in the C-suite, if they're not involved at that point, knowledgeable with what's going on. By that point, heck, the CFO knows, the in-house counsel knows. And at the end of the day, you want to bring people on, but again, I had another incident where we tried to keep everything very quiet. We told everybody don't spread the word of what we're doing. And all of a sudden on the front page of the local business journal, this is about 10 years ago, there's a big notice that our client is being sold. And I don't know who came up with it. And he's livid. And it causes confusion with the employees because now they feel betrayed and they've lost a lot of trust. Now, an investment banker comes in, you're representing the buyer. How do you handle it from your vantage point?
In representing the buyer, what I care and what any buyer cares about is I typically, in a traditional buyout, I want the business to continue to run the next day exactly the same as it did the day before I closed. I don't want anything to change, right? I want any change that will happen to be as a result of intentionality, right? Specific things that I chose to
Right.
do, right? Not somebody running off into the sunset and then quitting. So there's a few things that I would do. The first piece is that, Dave, as much as yes, I want to have a definitive agreement signed if I'm the seller to talk to my employees first, I identify who the key employees are.
Right.
And I do want to talk to some of those key employees before I have a transaction because I need them to know that A, I'm a real person, B, I'm not trying to lay them off on the day of close, and C, if they're competent. If they're not competent and I find out that the seller who is retiring is the one that is driving the whole thing and he's the only one that actually knows what he's doing, that's going to change how I underwrite the business, right?
Absolutely.
And the growth case.
Absolutely.
So that's a big dynamic. But yes, I want to get market employment agreements buttoned up as part of diligence with those key employees. The other piece is that I strongly encourage the seller to pay some sort of what we call a CIC or change in control bonus.
Or stay bonus.
Or a stay bonus, yeah.
Yeah.
So essentially and a lot of times those individuals that have really been core to getting through diligence will get a bigger bonus, right?
Right.
I've seen it done, where you'll get $1,000 for every year you've been there, or I'm going to pay you one-time salary because you survived quality of earnings, right? And yeah, that's $100,000, $150,000 bonus, right? But if that person is integral to the operations of the business, and I'm getting a $50 million check, writing out $1 million in stay bonuses is a small price to pay to ensure that the buyer doesn't come back to me later coming after that indemnity escrow, right? Or some of those other holdback money.
You want to be very clear on that because I've seen some people say you're going to get something, but they're not very clear on it. And then there's dissatisfaction and then people leave. One way to deal with this is you, as a seller, you get with the buyer, go, let's talk about the incentive and benefits programs that exist, not to stay, but going forward. Am I getting a better deal? They want to have at least the same deal at the end of the day that I find.
Yeah, so you can do, management incentive pool is huge. The other piece is splitting up the stay bonus into two parts. You can pay half at closing and then half 12 or 18 months after.
Absolutely.
I'm not a fan of that because it doesn't kind of put the good faith. It shifts the responsibility to the employee instead of thanking them. It changes the tone. When someone is thanked and valued, they usually want to stick around, especially if the seller is sticking around for a year or so, right?
Absolutely.
But anyway, I know we're probably running light on time, so I know we probably need to move on. That's something I can talk about for a long time.
Well, yeah, you and me. Well, this is like Oppenheimer, all right? They're so enthralled, they're just going to hang out there for a while, see if we can actually build a bomb. So there are going to be adjustments made, and the value of a happy deal. I put that in there because, at the end of the day, you don't want to win the battle and lose the war. You want to find a way that makes it palatable for both sides. And I know that's tough. You may leave some money on the table. The question is how much and what's reasonable. I say there's two things in my practice, or two things in the practice that I've seen that I think is most enjoyable for an attorney. One is adoption by definition, right? And the other is when the deal closes and everybody gets what they want. So you want to stay focused on that goal line and end game, figure out how to get there. understand we can walk away from the deal anytime. There may be some parameters. We've mentioned some of them as to a reason to walk away. But at the end of the day, we're going to be running out of gas. We're going to be at this point of the transaction, we're exhausted. And we're going to have to figure out how to get through to the other side and find the ultimate deal. The impacts, frankly, that we want to look at, make sure we have a happy deal, is to be able to negotiate a certain amount of what I call profits and compensations for the individuals, and earnouts and rollovers if in fact the deal as it exists may not make it to the goal line. So I want, as I say, run too deep at this position. I want to come up with other ways that we can try to make a deal work if we're getting stuck on money. I will also remember at this point whether I'm dealing with a financial buyer or a strategic buyer. Why? Because there are different motivations. To me, a financial buyer, and Sean can speak to this, it's about the numbers. That's a little self-limiting and maybe even a little borderline prejudice. I apologize, Sean, but the strategic buyer is probably thinking out in his mind 3 to 5 years, in advance. What is this thing going to happen? But there will always be the potential, if we don't get things resolved, for litigation and dispute resolution. It's expensive. I've never seen anybody win through that unless there's fraud. Sean talked to it earlier. Fraud is a whole nother area code, and that will always go to litigation in my way of thinking about things. But here's the reality. We want to make good adjustments because we want good relationships. At the end of the day, even if you've sold your company, you're going to have a relationship with these people. So if you trade off now being unbelievably difficult, it's probably going to cost you post-closing. Okay. And here's the thing. Don't try to win every battle. It doesn't work. Only get hung up over the serious thing. When somebody comes in and go, I have to have my company car. Really? I mean, you have to have it. Are there any other cars out there in the world? Can we work on those things? That's not a serious issue. Purchase price is a serious issue. Or riffing a lot of people, or putting the company in a position that's disadvantageous because it is your legacy. Sean, what are your thoughts?
Yeah, I think the key part is relationships, and knowing, especially, I mean, we've got a transaction right now that's been a year and a half in the process.
Mm-hmm.
They had a fire at one of their facilities right at the week after an LOI was signed, and that's a completely reasonable reason to reconsider a structure, right? And that's what we had to do. But the owner is planning to stick around with the business. He's rolling a material amount of his equity alongside the buyer as part of the new deal. And he and this buyer, who's an independent sponsor, they're going to run the business to grow the business together. So that relationship matters, and we've impressed upon that, for both of them, right? That, hey, I know we're tired, but we just got to keep moving. I guess the only other piece I would say on the financial side, you mentioned that for financial buyers, it's all about the numbers. It's all about the numbers to the extent that financial, accounting is kind of like the English language, right? There's slang to it. There's slang to it. There's different ways of looking at it, but end of the day, numbers are numbers. Just like letters are letters, and it's a function of, are the numbers real, and understanding through what lens are they real, right? But the other piece is that every financial buyer has a different lens through which they're looking at it. They have different operating metrics, they have different relationships, they have different portfolio companies that they can share expenses with. And it really gets back to with any of these deals, it's always for any buyer, whether you're strategic, financial, family office, individual with an SBA loan. It's a function of any business you're looking at. You have to identify the moat, and you have to identify the margin of error. And to borrow from Warren Buffett and Charlie Munger, that margin of error is razor thin when you're an independent sponsor, because you have to raise money and you have to pass that information along to people that are going to loan you money and invest capital alongside you. If you are a large private equity firm with a portfolio company that is 10 times the size of this business, and this is just going to be an add-on, you probably got $500,000 of margin of error on EBITDA, before you really start to get concerned, right? It really depends through the lens through which you're looking. So
You know,
I think
at
the
the
adjustments piece, understanding your leverage points. I mean, end of the day, the best deal makers I've seen are ones that can change their mind on a dime because new information comes.
yes, yes, brilliantly put out there. You know, always remember, even Dorothy and Toto survived the tornado in the movie The Wizard of Oz. So you're going to be able to go through this. There are going to be some adjustments. You're going to have to move one way or the other, but there is always, you know, you can always go home at the
Yep,
end of the
yep,
story.
yep.
As far as notifying employees of the impending M&A, we talked about this. Here's the thing. It's like, you got to go talk to them. You don't get to send out emails or memos. Now, when I have a company, I've had a couple of companies over 1,000 employees. That's a little difficult. So you delegate that and you come up with people, usually some type of a PR firm or some grouping of people that can come in and communicate. But the question always is, be sure to communicate with them. You give them the information. You in a perfect world, you're going to go down when you've got 1,000 people. You're probably going to drill down on that pretty close to closing, and maybe even closing on that size of a business. What they want to know at the end of the day is, what is the impact on them? That seems to be
Yep.
at alpha and omega.
Yep.
And at the end of the day, if their life isn't disturbed, that's going to take care of about 75%. There's going to be 25% that will be forecasting what it might mean for them. And that becomes a little more problematic. So you may have multiple levels of conversation depending on where they are in the company. But at this point of the economy, it is so critical you take care of these people at the highest level. None of us can afford to lose really good people. It's just not going to be possible, I think, for the rest of this generation to find the right people to come in and supplement them. And even if you can't, you got training. You've got to get them on board with the culture. They've got to understand the purpose. I mean, I'm sure preaching to a lot of business owners. I'm not telling them anything they don't know, but the timing, the feed, and carrying of them is so critical. Sean, what are your thoughts?
Yeah, so the timing, as we referenced earlier, different employees need to hear different things at different times. If you are, um, if you're an organization with 2,000 employees spread across a lot of different factories, then key management probably needs to get, brought together, and told in person. And typically, I love to have that done by the selling group
Right,
in person with a representative from the buyer.
right,
Typically, if they're putting a new CEO in there, it's the CEO goes there, he shakes the hands and casts the new vision for the employees, right? And some of that is performative, right? But it needs to happen,
yep,
so they can understand who they're dealing with. It's Dave, to your point, people knowing people knowing that they're valued, people knowing that there is opportunity for them at the current company, and people knowing 9 times out of 10, it's, am I getting laid off?
yep,
People understanding that they are not being laid off, or being communicated to in advance that they are going to be laid off, and here is why I need your help to get me through this transaction.
absolutely.
I had a transaction, about a year ago that was it was in the wholesale space. The business bought the inventory and bought the IP of the brand, shipped all the inventory across the country, and shut down the business. And
Yep,
the employees were let go. But those employees were told in advance. And
right,
the owner was 80 something years old and needed to retire. And it was a small group of employees that were all paid very handsomely. Essentially, I think all of them got paid, 1x their salary or something like that, right? I mean, they all got paid very well, so that they could find that they had 3 to 4 months to find something else, right? So there's a level of loyalty there, but every situation's unique. Every situation's different. Most buyers want to continue with the employees if it strategically makes sense.
Without exception. I have one client that goes around the country and buys businesses mainly to get their high quality employees. He's
Yeah.
looking first and foremost at the employees, but
We call it accu hiring. There's a lot of
yeah,
reason to buy a small business if they've got
right.
great people.
Absolutely critical.
Well, this
Here's it.
was great.
Go ahead.
Yeah, I think we need to go into a couple of questions. There's a couple of quick questions that we can conclude. But this was a fantastic session. I let you go over a little bit because we're imparting so much valuable information and insight. Both of you have a wealth of experience, and not only did you bring your experience, but you worked very hard to prepare this presentation. I know there were a lot of conference calls and a lot of communications between Dave and Sean, so very much appreciate all those efforts. So just one quick question. When you're representing the sellers, are there ever retradings on the upside? If the circumstances have changed, if they got some patents granted, got some regulatory approvals, the economy's getting better, what have you, you know, any situations where you would help your seller retrade on the upside?
You know, great question. The simple answer is rarely, but I see retrading and upside. What they're going to come back to you and go, I'm not going to pay you more money at close, but I might give you a rollover you might not have expected, or I'm going to do an earnout, okay, because you think it's coming. Because, you know, frankly, at the end of the day, it's still future forecast. We're not entirely sure. I want to make sure, because nothing succeeds like money in the bank. So that's usually where I see it. Once in a while, they'll get some more money if you have prepared in advance that this is coming in. You know, I've got a client right now. We're looking at 2 different ventures that are 9 figures, and we're telling the buyer that we've got those out there. But we're not at that table right now where I can give them a contract, and there's a lot of variables. So I think that's the big issue. What do you see, Sean?
Yeah, so it's almost all on the come, right? It's kind of on the future. I think where I have seen, I think it's important to know how businesses calculate the returns, right? It's almost most of it is on the exit, right?
Yeah.
So I think a lot of it is driven by if we can defer that consideration into the future, the more we can do that, the better. So a lot of times what I'll see is, you know, what I started seeing really last year more consistently was kind of contingent seller notes, which are kind of earnouts, but they go to the balance sheet. So it's a earnout, but once it's earned, I will put it on the balance sheet. I'll recognize it at its value. You will essentially get, you know, a paid in kind, you know, interest on the back end, and you know, or an exit bonus, right? Those are very simple ways for buyers to give more consideration without affecting their expense upfront, which most financial buyers, well, all financial buyers, that's what they're driven by, is kind of over the 5 years or over their projected hold period, can they, you know, move as much of that to the back end so that they can have enough working capital to grow the business in the near term. So
great. And there's the final question. You know, after the deal closes, it seems like there's still some lingering work that needs to be done. You know, true up calculations, that kind of thing. You know, I would imagine that David, you know, charges by the hour, and you know that's fine. But when it comes to investment bankers, you've already gotten paid before then, right? So what can a client expect from a good investment banker in terms of ongoing support for answering other questions, dealing with maybe lingering change of control issues, escrow issues, true up issues after you've already been paid?
Yeah, Dave, I want to know what you think first, and then I'll answer.
Well, usually I tell people, I give them a range of what they should expect. And I did it recently where, you know, I said it includes post-closing matters, and it was a $160 million deal. So I was out of pocket, but I kind of calculated that in, but I put parameters around and create a scope. If it's just follow-up stuff, you know, that's got to be included in the package, all things being equal. But if there's a lawsuit that comes up, or, you know, some type of serious claim that wasn't anticipated, it'll be hourly.
Yeah, so I think, David, to your point, yeah, we're not paid hourly. So essentially we've already been paid. That being said, it really comes down to a professional integrity perspective, right? It's a, you know, beside the fact that we mentioned deal fatigue, right? We didn't mention the emotion of the deal.
Mhm.
You go through 90, 120, 150 days with a seller that's never sold a business or gone through an institutional capital diligence process before. Um, I'd argue more than the attorneys, become the priest, the rabbi, the best friend, the person that they are relying on to keep them sane over the course of that, over that process. We are the ones getting the emails at 10 o'clock at night that we need to respond to quickly because they're thinking about killing the deal. And these people become friends of ours, very close friends, right? Because you've been through a very
Right.
important thing with them. You've gone to battle
Yeah.
with them, right? And I think to that extent, you also don't want to leave them hanging, right? Because they're a friend
Right.
now. So, just from work ethic perspective and an integrity perspective, that's not how I operate, right?
Yeah.
I,
Agreed.
I want to handle the people in my network, and yeah, if they know someone that wants to, sell a business or buy a business, yeah, I want to have a shot at that business, right?
Well,
So
Sean,
I
you and I have a
treat people
soft
with
heart.
kindness. So
Yeah. Okay.
You and I have a soft heart. That's the reality.
no, I believe you. So
Well, anyway, I think we have to break here again. We could continue on for quite some time. I don't know how the session could have gone any better. Extremely informative, good interaction, good chemistry. So I'd like to thank David Sider from Spencer Fain and Sean Ostrander from Merit Investment Bank. And just a little footnote, Dave runs a podcast and he provided the QR code on the slide that he showed us at the end. So feel free to listen to Dave's podcast as well. All right, so that concludes this session. Thank you.
Thank you.
awesome. Thanks all.
Okay, so Brian, you can get us set up with